we expect there is a breakout. There's a 5-wave structure here. There appears to be a head, double head and shoulders. Use this neckline, looking at this. So I don't want to take out the fibs because we're going to use them later. The United States dollar against the yen is a fundamental buy. Yields will rise all the way above 2%, we think. And you only see depreciation in the United States dollar against the yen when there is a slight depreciation in yields. So yields were at 1.63, they depreciated a bit. Probably they will be on the rise again. So remember what was said, whenever we see negative momentum on the 15 minutes, we just buy the market. We usually would have a buy entry at 78.6 and 61.8. This is an advancing market. So at 78.6 we would have got filled. We talked about this, I believe, yesterday. You leave your entry full size. We'll take a look at the analysis now. At 78.6 or 61.8, after the entry gets filled, you get a confirmation that the momentum has reversed. There was negative momentum on the 5, there was negative momentum on the 15, there was even negative momentum on the 30 minutes. This is unprecedented, but didn't take you below 78.6. So you only get a confirmation that the market will be going up by using momentum as a confirmation that the correction is over and not as a trigger. We have now confirmation that the correction is over because of course 30-minute momentum is about to break out higher. 1 hour momentum is very bullish, and we just checked it, a 0 line bounce. Okay, so where can we enter if we're not already in the market? You're having, of course, double inverted heads. You have a right shoulder. We think the market is going to break higher. Maybe we're still going to get these levels. You can see an Elliott structure here, 1, 2, 3, 4, 5. Correction of this will take you to 113.5, 113.45. Of course, it's going to be 113.5. Current market is 113.64. Okay, so if we enter 113.5, what are we going to do? How are we going to manage the trade? And what kind of risk are we carrying or are we holding? You can see we're having 0 line rejections. At the most you have some kind of a wedge. We're still going lower, but I really doubt it. Alright, let's take a look at the analysis now. We want to note that all corrections that we're seeing or retractions that we're seeing are supported on top of level 1. Okay, so this level 1 is at maybe 112. We'll take a look at 1 hour chart. True, we're buying 100 points higher, 150 points higher, but the market isn't really even gonna test level 1. So if we want to get into it, we just have to get into it at higher levels. We are supported at this level 1 here in yellow. Okay, so we were at this yesterday. There is going to be a correction down to 113.3 and maybe 113. What actually happened live on the market was just a correction to 113.3. So if we had an entry at 113.3, sorry, we would have gotten filled. Right, we're on our way to 119. We are investing into this. Let's see how and why. All right, so again, we would use fibs, draw them right from the beginning of the move. We're looking at, of course, level 2 here. This is a 2 hour chart all the way to the top of the market. Below the neckline, all the way to the top of the market. You get this fib structure or this fib retraction projections. Okay, so this is shown, these are the same fibs on the 1 hour and 2 hour charts. They're shown on the 5 minutes. It would mean that any retraction in this current uptrend, it's a rapidly advancing market, will just take you to 78.6%, 113.3. So what we would do is leave our full entry at 78.6%, blind without taking any triggers. Once that correction does run in, we get filled. All right, we check momentum. Usually what we need just a confirmation that the retractive momentum is finished, that the correction is finished. We will see that the momentum on the 5 minutes and 15 minutes has made cycle extremes, and that the 1 hour is still positive, and that means that the market is still moving higher, and this is an extension, and the trend is set all the way to 119 levels. We'll take a look at why 119 in a minute. All right, but let's do that also. This is 119. We're going to that neckline, of course, having heads. We've broken out of this cycle. There is an internal cycle here, so we're doing the higher cycle. The fundamental that did this higher cycle earlier is impacting the market again. We're doing the higher cycle. That fundamental, of course, was stronger dollar yields. It's back again, so we're doing that higher cycle. Alright, so let's get back to trade management. We will just make the whole complete fill at 113 because we're going to 119, 113.30. Alright, and do our risk management analysis very carefully. So risk management analysis would indicate, first of all, that we take care of the losses and then we look at the profits. How much do we want to lose for this operation here? Say we're gonna risk or lose $600. Okay, so we go back to that 5-minute chart. We find that if the market is going to break two necklines, so we have two necklines here. That is the first neckline, the second neckline. If the market is going to break two necklines, it will have to do a higher degree correction, and that means there is an Elliott structure down, and we want to close out our longs at profit or at whatever, or at least secure them, go out of the position, and therefore our stop or hedge, depending on how we manage our money, must be at least two necklines down, two necklines below our entry. Our entry is 113.3. right now is going to be 113 point, I believe we just checked this, 113.45 or 113.5. let's say it's 113.5, 61.8 here, so 113.5. all right, so our entry is 113.5. we have to, okay, so our stop is going to have to be two necklines below that. We're going to have a stop at 112.2. Okay, 112.2 is not only two necklines below that, it's two primary necklines below our entry. This is neckline 1, this is neckline 2. We have to have a very strong reversal in order to get that far, 112.2. So if you're buying right now 113.5 and the stop is 112.2, this is 130 points, $130 per mini. Okay, if you multiply that by 4, you're looking at $500. Okay, if you multiply that by 5, so you're looking at $750. Over here we're looking to risk $600. We may raise it, maybe, if you wish, or use just 4 minutes. We need to get half of a standard contract in the position in the early stages. These are now the early stages. Okay, how do you know these are the early stages? Because whatever is happening on the 5 minutes is actually a fraction of what will be happening on the month. On the months we have a breakout, just like we're having on the 5 minutes, on the 1 hour. Okay, we're going to the next neckline. This is the next neckline, just like we're doing on the shorter term time frames. Next neckline is 119. So this is the early stage of the trend. We cannot afford to be left out. Really, we cannot afford to be left out. And we have to work our risk and profit calculations correctly. So if we're gonna use $600 risk, it's gonna be 4 minutes. If we raise it to $750, it's gonna be half a standard. As we go higher, we'll only be able to add another 2.5 minutes every 100 points or so. So we're gonna be adding another 2.5 minutes at 114.4 or 114.5, 2.5 minutes at 115.5, and that's it. We hold the position all the way to 119. We'll be holding one standard contract. One standard contract at 119.7 will do us $6,000. That level here. Forget about 114.7. We're almost there now. Alright, so we're risking, of course, $750 against $6,000. The trade is a go, definitely. And this is a positive swap. The longer you hold, more money you'll be making. The trade may actually work out faster than expected. So we had a drop in yields today. Even with that drop, we didn't do any correction. We just bounced at 113.22. Okay, we didn't even do 113. So it's better to buy upfront 78.6% of any advance, of the current advance. Have the stop there. This is a very lucrative trade. We call it you park some of your account into that trade. Alright, and this is the parking ticket, $600. It's as simple as that. You park money there, they will give you interest, alright, and you can actually have a sudden rise in yields and in inflation. You don't have to wait until the end of the year. You don't have to wait until early even next year. This could happen actually, I don't want to say overnight, but it could happen much faster than we all expect. So we're in the trade. If it happens much faster than we all expect, we're into 120 quite quickly. We're looking at, of course, $6,000 if that's a standard contract. If you increase the size, maybe risk $1,000 here. You're looking, of course, at 12,000 in reward or 10,000 in reward. So the last time this move happened was during Trump's presidency. When he won the presidency, we were trading United States dollar against the yen. United States dollar against the yen took off from actually 101. All right, yeah, I remember, even 100.9, 101, all the way up to 118 and 117, 1,800 points. The time, actually the move from 101 all the way to 114 was 1 week, 2 weeks. 118, it took another month, but just 2 weeks, even less. I remember that time very well. We need to use opportunities in a correct manner. You cannot use opportunities in a correct manner when they break out. They're sudden and no one is ever prepared. You only can use them in a correct manner if you are fortunate enough to be positioned already well into that opportunity before it breaks out. So we are positioning hopefully ourselves in the right direction into that opportunity before it breaks out, and just wait patiently until it does break out. It doesn't really have to be 2 months or 3 months. It can just be 4 days, it can be a fortnight, 1 week. That opportunity does break out, which is aggressively rise in yields. Alright, so I would consider to buy again. Everyone would have to do their own due diligence. Any retraction now into 113.5. This is about to be seen. Okay, so just to know what could happen technically, I do not really expect it, but we're looking, of course, at some kind of a wedge or broadening formation. We may run all the way down to 113. We're looking at 61.8. We have checked we could consider that you want to leave your entry at 61.8, which is 113. But then again, it may be that the market will move higher. We're having positive momentum across the board now. So we're not, this is 113 here, 112.92. Okay, this is 61.8% of the uptrend. So maybe we get there, maybe we don't get there. If we don't get there and the market moves into 114, then of course we have missed the entry. It's better to be in at 113.5 and accommodate, all right, the negative PL that we will be holding, even if we go down all the way to 112.2. We have ways and means in order to protect that position and make money on the side while we're holding that position by hedging shorts just for very small runs between necklines or between 50% between adjacent necklines to make some extra money on the side if the position will be delayed. But it's, I believe, my take on it is much better to be already invested in it before it begins to move any higher. We were talking about this yesterday. CFDs are actually insurance policies. We are in very vibrant times in the world, and many institutions will be using contracts for differences or CFDs to protect positions or to insure positions. So you'll have abrupt and sudden moves because they're going to be changes in events. Yields up, yields down, oil up. You'll find very strong moves in CFD contracts. Okay, so if we get to be correctly positioned, we can take opportunity of such sudden moves because the contracts will move very, very wide or very fast during such periods of turmoil.